If I'm getting a stimulus package, should I take it? Will it impact on my immigration status? When should I go with a CPA or a professional? And when should I do a tax return by myself?
You are an H1, you kind of like at the green card, the EAD state.
For an immigrant who is on a work visa here to save on taxes.
That is actually a very good tax saving benefit for a lot of those H1 people that Interestingly, if you do have parents who came and stayed with you for 6 months out of the year, you can claim them dependent on their return.
They have to file tax return back there in their own country. So, and here in United States also.
Legally, you have income in India and you're not going to declare here.
And what if someone has a rental property here in US?
Those have to be filled. There are steep penalties if you don't do that.
Oh yeah, this is actually a very helpful tip. Hello and welcome to Life of Us or Life of US. So it's the beginning of the year and everyone is running to file their taxes. And we were fortunate enough to talk to a reputed CPA from California. So let's start the discussion. Hey, hi Hina, how are you?
Hey Rajat, good, how are you?
Good, good. So if you can quickly introduce yourself to our audience.
Sure. I'm Hina Rajab. I'm a CPA based off Los Angeles here in California. Basically, I've been in this field for about 20 years. I've been a CPA for 11. And before that, I was just like, when I was a student and stuff. So technically been doing taxes and accounting for about 20 years now.
Great. So quickly coming to the questions, my first question would be, what is the right time to do a tax return? And when should I do a tax return?
At the end of the day, if you have income, you should file taxes. The way it works in US is your audit timeline begins after you file your taxes. So if you've had income and you did not file taxes, now you can be audited anytime because that timeline never started. But if you filed your return, if you had anything to declare, the timeline starts, you are good to go, assuming, you kind of did what you were supposed to do. So that's where I stand. At the end of the day, you earn income, you pay taxes.
Okay. My next question would be, when should I go with a CPA or a professional, and when should I do a tax return by myself?
Okay, I get that a lot, and I'll tell you what I personally feel about it. If you're something who can do, who's a little more confident within themselves, and who has a basic W-2, honestly, I don't think you need a professional. You could do, your TurboTax, H&R Block, kind of .com, whatever, and you'll be perfectly fine. I do have clients who do have only W-2, but they still come to me. But their main idea is they want peace of mind. That's all the reason. There is nothing. At the end of the numbers are the same if you are a simple W-2. So you come to me or you do on a TurboTax, I cannot give you a better result just because you're with me, because it's not something I can get you extra. It's, there's a structure and numbers that work in the background. So if you want something, you want to get into investments, you want to get into tax planning, even with one W-2, yes, go to a professional. But if you're someone who will just get a W-2, we're just going to file it, there's nothing much happening, you're perfectly fine doing it. Though I do have to add that if you think you're going to go to H&R Block, one of those franchises, you'll be surprised. You might as well contact a little better professional. You'll probably be paying the same cost.
So Hina, our next question is, what as a working professional on a work visa I can do to save some money on my tax return?
It's a little harder if you are on an H1 to get multiple gigs or businesses going, because whatever the stringent laws of the visas are, and you certainly should stay within that. There's small things that a couple of things that you can definitely do. One is certainly investment, be it maximize your 401k if you have that's a big one. 401k should definitely be maxed out. You have a non-working spouse, make sure you put it in traditional IRA. That helps the bottom line. You can put up to $6,000 for your spouse in it, and 25% of that is refundable credit. So that is a big help too. One of the other things that I do for some of my clients, again, there's an eligibility criteria for it, but we have parents that do come from foreign countries and they stay with their kids, their sons or daughters for a certain period of time. Interestingly, if you do have parents who came and stayed with you for 6 months out of the year, it's a little harder because sometimes parents don't stay for 6 months. I mean, they got the visa, they may be flying like 2 months later. So now they anyways don't have 6 months left on their visas. It's about 4 months or whatever. But if they are able to do that, you can claim them dependent on their return.
Oh, wow.
What you do have, you will need a professional help for that because
Okay.
an ITN, it's a substitute of a social security. This is something I'm sure being on H1, you do realize your spouses or your kids initially get ITN and not really a social security number. That has to be applied for. And once you get it, that document has to be notarized, but a professional can help you and guide you with it, because then you will be able to claim your parents, visiting parents, if they are here for 180 days, essentially 6 months, can be claimed as dependents, and that definitely can help our bottom line. So just another way to, get some extra mileage on the return.
Oh, yeah. This is actually a very helpful tip. And since I mentioned this is basically for the working professionals who are here on a working visa, they have to file tax return back there in their own country. So, and here in United States also. So like a dual taxation kind of thing. So if you can explain or give some information on dual taxation, how do they do that in US
Okay,
and
so
abroad?
at the end of the day,
In their
if
home
you're
country.
coming
Sorry.
from any country that does dual taxation, most of the countries or the clients that I've had, their countries do have what do you call a treaty with the US from a dual standpoint. So what happens, I'll give you simplest example, is going to be India. That's the easiest one we can take here, is if you, for whatever reason, are filing taxes back in India, and then you have to file it here because you're staying here, that's where your source of income is, you're working here. Whatever you file in India, you can claim, you will have to declare that as an income in this, of course, in US too. Keep in mind, US anyways taxes world income. So if you think legally you have income in India and you're not going to declare here, from its US standpoint, you're anyways in hot waters. So make sure you're declaring. But let's come back to the question. So if you are having income in India, you're filing taxes there, you will declare that income. There's a formula in an IRS tax table that comes for conversion. You can't just use any conversion rate. It's an IRS issued conversion rate for the entire world that they issue every year. So there's a certain way to do it, but you pick up that income from your Indian tax return, put it in the US, you will claim that as an income. That being said, whatever you paid in taxes in India is also converted and then is used as a credit. It's a foreign tax credit paid to whichever country you come from. And that also offsets whatever income this foreign income will be, for the tax that will be this foreign income generating. So you pick up income and you pick up taxes. So at the end of the day, that's where the dual thing comes in. And we prepare the tax accordingly.
Okay. And if any of the viewers want to get more information, is there any like you have any website or they can contact you or something like that?
Most certainly. It's pretty simple. It's Henna, it's my name with CPA.com. You could post, I have a contact form there. You could kind of post it there. My information is pretty much there. Or you could email me. Everything is on that website, or you can just look me up. And they can definitely shoot me an email. I'll be more than happy to answer some simpler questions.
Sure. We will also provide your email in the description box.
Sure.
And one more thing. So coming from this answer only, what you just gave, you mentioned that if we have an investment in India, we should or we have to declare it in US. So what is the criteria? Is there, rather, I should ask, is there a criteria for declaring that investment which I have in India or abroad when I'm filing my tax in US? And what is the process, or is there any form we need to fill or anything?
Okay, so if you're not filing taxes in India, there is no active anything happening back. You don't have. Some of my clients have rental properties, so they do have to file active return, but then some of them don't. So, but with the people who don't file active returns, if you do have more than $10,000 in your bank account, or let's say liquid assets, that doesn't include properties, that doesn't include your, let's say, some things sitting somewhere. I don't know how to say this, but at the end of the day, your cash, your savings, your stocks, if there's money in the money market there for you, your provident fund, whatever you may call it, that can be converted into liquid cash within 48 hours. Take that money, including if you're a signatory authority. You got most of the people have older parents back home, and they are the signatory authority on their parents' bank returns. If that's the case, and your parents happen to have more than $10,000 in their bank accounts or any shape or form, you have to declare that money here. There's FASBA there. A form that needs to be filled, and then there is the F bar, which is the most common that everybody knows. Those have to be filled. There are steep penalties if you don't do that, and basically US is doing it just to avoid what India had an issue. A lot of people had an issue with the Swiss bank accounts where they don't know the people who live in the country where there's money stacked for. It's not taxable. It's just pure information, but that certainly should be filed.
Okay. And what if someone has a rental property here in US, and though he's on a work visa? So in that case, he needs to declare, like when he's filing a tax, should he or she should do a itemized tax return or a regular tax return? What is the complication in that? Do we need to hire a CPA at that time, or we can do it by ourselves?
I'll tell you what, at the end of the day, if you are anybody who has anything more than a W-2, ideally, you should be having someone to discuss things. And that's only because I have clients who come up that I can give them strategies of how to save taxes or how to plan better in terms of their strategizing their retirement accounts, which is like a big thing in this country, at least. That is definitely focused. And the other best part of that is when you do, even if you think it's retirement, it's not really on a long-term basis that whatever is going to happen at 65 and after. This is going to have immediate effect on your taxes right now, because the government does want you to be well prepared when you retire and less headache on them. So that's why they do offer these credits in very many shapes and forms, so that you are more prepared when you hit your old age, while you take advantage of it, saving. So if in your case, your question, coming back to your question where we are talking about the rental income, in that case, you certainly need to have someone, unless, like I said, you have confidence in yourself, you can do enough research, and you're okay sending your returns. If you have a rental property, of course you have to put that in the return. It's a income you're earning. Somebody else is paying your mortgage. I mean, helping towards paying your mortgage. Let's put it that way. But one of the best parts of having a rental property, if they were to do right now, is a few years ago under the Trump, the TCJA Act that was passed. They basically made a little more permanent case for people who have rental properties, to the point that you can take up to $25,000, assuming you're active management, your own property. You haven't hired a management company to do it, but you're doing it yourself. You find your own renters. You, if there's a problem, you are the one who's going to that house and fixing things. So you're basically managing your own property. You can take up to $25,000 of losses every year on your taxes.
Okay.
Generally, that is because of depreciation you're going to take, and that offsets your actual W-2 that you must be earning, which can, I mean, a $25,000 on a W-2 can make a big difference. Definitely straightforward, a tax decrease. Most likely, it's decent enough number where it could actually even cause you to drop a bracket or two in terms of your, where you fall in your tax bracket. So it's certainly a good way to go, both to build a wealth or properties and get some tax savings while at it.
Okay, cool. Coming to a final question, and the most important question, especially in these times. So a government is giving stimulus package now.
Yeah.
And being on a work visa, if I'm getting a stimulus package, should I take it? Will it impact on my immigration status? Probably for that we need to also consult attorney. But from a tax point of view, will it impact on my tax return, or will it impact on my immigration? Any information on that if you can give?
Sure. Stimulus, from my standpoint, again, do talk to your attorney, but from a tax standpoint, has and should not have any bearing on your filing of, or put your citizenship path to any endangerment, if that for the lack of a better word. At the end of the day, this money was given to whoever in this country is legally paying taxes. That's what it is for. It really is irrespective of the fact whether you're H1 citizen or a green card holder. At the end of the day, I also just want to reiterate that keep in mind, a lot of people got this money into their bank accounts directly. So just from that aspect, you could not, nobody in the same mind, including the government, cannot hold you responsible for giving you the money that they automatically put in your account. There was not an option of a yes or no. If you applied, if you filed your taxes and you qualified, you got the money. So if you are one of those people, or you have people who have not cashed their checks, by the way, 6 months after the check's been issued, it's automatically null and void. So if the check's still sitting, it's void. But if you have the check sitting, it is valid, go deposit the check. And if you're one of those people who didn't get the check and are not looking to ask for it because this thing is looming over your head, when you file your taxes, you have another opportunity to go say that, okay, I didn't get it, and still claim it on your taxes. That's your due money based on your prior returns. So make sure you get it. It should not have any negative effect on your immigration status, for sure.
So if we have not claimed that in 2020, we still have time, and we can go ahead and do it in 2021.
Yes, and let me give a interesting aspect to that. If you have someone who was working in 2019 and let's say earned $100,000, single person, and lost the job, now when the stimulus was initially declared, for a single person, anybody making 75,000 or more was kind of cut off. You didn't get the stimulus because you were over the 75,000 mark and you were making $100,000 because that's what you filed in your 2019 return. Now, come 2020, let's say I know H1 is going to be a bigger headache, but if you were like a EAD kind of person who didn't, losing a job didn't make that big of a difference because you could, jump ship from one to the other. Mm-hmm. If you did get less money in 19 and all of a sudden in 2020, you either had to take a pay cut or you had a time where you did not make money, and all of a sudden in 2020, instead of the $100,000, you made 65. You can still go back and claim it because you qualified under the original original written arguments, because the government, when it announced it, did not have taxes for everybody at that time filed. It was anyways extended. So that's why they went to 2019 and picked up numbers and got sent out or gave the checks or electronically deposited based on 2019. 2020 wasn't filed. Now that 2020 is filed, these stimulus checks are based on 2020, not on 2019. So if you you didn't get earlier because you were all the way up, the 75,000, you should claim it now. If you got portion of it because as it gradually phases off, you didn't get full, let's say, you're married, $2,400 it should have been, but because you're on the higher end, you got $1,800 or whatever. But now based on 2020, you are under that criteria. You can go do the calculation and get the difference, which you duly deserve. So make sure that is taken care of as well.
Okay. Thank you so much, Hina, for all this information. This will definitely help our viewers, not this year, maybe in all the coming years. So thank you so much for all the information.
No, I appreciate it. I'm sure you'll have a lot of people who can utilize it, and I'm sure they'll thank you for putting this out. So kudos to you.
Thank you so much.
No problem. Thank you. Take care.
So hope you got some useful information from this video. And if you still have any questions related to your tax return, so please feel free to contact either Hina directly, or you can leave those questions on the comment section below. And if we have enough questions, maybe we can talk to Hina again and maybe do a live session. Yeah, so please leave your questions in the comment section below. Again, thanks for watching. Please like, share, and subscribe to our channel. Thank you so much.